trillions of dollars have entered the artificial intelligence sector in just the last few years. Many market analysts are identifying valuations that defy historical logic. Companies with no revenue receiving billion-dollar price tags, driven by a collective fear of missing out. For anyone with money in tech stocks, index funds, or a standard retirement account, the current state of the market creates a significant risk to existing capital. Depending on how an investor positions themselves now, the coming shift will either result in a substantial loss of savings or provide a specific path to acquire assets if valuation's correct. Welcome back to Minted Mosaics, where we simplify finance so you can build your financial masterpiece piece by piece. Today, we are breaking down the AI market cycle. We are going to examine the structural risks currently developing in the tech sector, explain how a market correction moves through a standard portfolio, and provide a strategy to insulate your money. Monitoring the AI market frenzy is a necessity. The current expansion is reaching its mathematical limit, and the survival of your long-term financial security depends on understanding what happens when the trend reverses. To understand current conditions, we have to look at the year 1999. During the dot-com bubble, companies that added .com to their branding saw their stock prices rise instantly, regardless of whether they were actually generating a profit. The internet was a viable, transformative technology, but that did not mean specific companies were worth billions of dollars at that moment. Their valuations were based on projection rather than performance. You can visualize a financial bubble using this balloon. The rubber boundary represents the actual value of a company, their real sales and profits. The air inside represents speculation. Currently, the AI market is pumping the balloon full of speculative air, inflating stock prices much faster than actual profits justify. When the rubber can no longer contain that pressure, the market undergoes a rapid correction. In 1999, the technology was real, but the valuations eventually hit a mathematical limit. Today, we are seeing the same pattern, a legitimate technological shift being overtaken by unsustainable market prices. The driver of a potential correction is a disconnect in corporate spending. Tech giants are currently committing hundreds of billions of dollars to AI infrastructure, which includes specialized microchips and massive data centers. This follows the logic of the California gold rush, where the most consistent profits went to the people selling picks and shovels. Today, investors are focusing their capital on the hardware companies that build the servers and the chips. To justify these massive upfront costs, companies must eventually sell AI software and services to businesses and consumers at a profit margin that offsets the infrastructure investment. This is where the math fails. Corporations are spending billions on infrastructure, but the revenue coming back in is relatively small. While many are using free AI tools, they are not yet adopting paid AI workflows at a scale that matches the corporate investment. When Wall Street requires proof of a return on this investment, and the profit reports show a significant revenue gap, it typically triggers a broad sell-off. Avoiding direct investment in AI startups does not necessarily insulate a portfolio from this risk. Most standard index funds, like the S&P 500, are market cap weighted, meaning the largest companies have the most influence on the fund's value. A handful of massive tech companies heavily involved in AI now make up roughly 1/3 of the entire index. Because the index is top-heavy, a decline in those specific tech stocks will mathematically lower the value of the entire index. A correction in the tech sector will not stay isolated. This structural vulnerability means a localized tech correction can move directly into 401ks, IRAs, and standard brokerage accounts. This is the contagion effect. It turns a specific industry risk into a broad market risk that affects the majority of diversified investors. Preparation is the primary tool for managing a market correction. One defensive approach is the barbell strategy. This involves spreading your capital between two extremes to manage risk. On one side, you allocate the majority of your capital to conservative assets. This includes high-yield savings, treasury bonds, and dividend-paying companies that provide essential goods, like groceries or utilities. On the other side, you place a small, controlled portion of your money into speculative tech stocks. This allows for participation in potential growth without risking the majority of your capital. Using this strategy can help neutralize contagion risk. It secures your primary savings while maintaining a small entry into the tech market. Market corrections often facilitate a transfer of assets. After the dot-com bubble burst, many companies failed, but it also provided a chance to buy shares of businesses like Amazon at a significant discount. As hype fades, the companies with sustainable business models remain. The strategy after a correction is to look for traditional businesses that are integrating AI internally to reduce their operating costs. For example, logistics companies are using AI to optimize truck routes and improve their margins. They aren't selling AI, they are using it to become more profitable. Similarly, healthcare firms are using AI to reduce the time and expense of discovering new medicines. These applications lead to measurable increases in efficiency. Long-term value is often found in fundamentally strong companies that use AI to lower their internal costs and create a more efficient competitive position in their own industries. The AI technological shift is real, but a disconnect in revenue typically leads to a market correction. Because major indexes are top-heavy with tech stocks, this correction will affect broad market funds. You can prepare by auditing your index exposure, using the barbell strategy to protect your core capital, and identifying fundamentally strong companies that may become available at a discount. Protecting your capital is the first step. To see how to position your money for future growth, click the video on your screen now, Top 5 Investment Strategies for 2026. We'll walk through the blueprint for the coming economy. Keep building your financial masterpiece, and I will see you there.